Without further ado, please welcome Madam Mazlina.
Okay, just give me a moment. Voice. All right, guys. Can you hear my voice? Boleh dengar tak?
Yes, Miss.
You nak tengok muka ke tak ya? Sebab cantik sangat. Dia terkejut. Tengok muka lah kan. All right. Let me see. Let me just put it on slideshow. Just give me a moment. Yeah. All right. Today I'm going to talk about a very, very brief introduction. Okay, by the way, I had a very lengthy introduction by Miss Lily. Well, you can just call me Madam Mas. If you have any questions, even during my presentation, do stop me. I'll be more than happy to answer your questions. All right, so today we're going to have a very brief overview to group accounting. Why I say is a brief overview, we have a specific paper for this. That means for the whole of 14 weeks, we have to learn on how to prepare group accounting. So what I'm going to tell you within the next an hour or so is just at the tip of the iceberg. I can't really share with you everything because it takes the whole semester to think about group accounting. So I'm just going to go with you the introduction. So this is the topic in mind. How do I make this smaller? Really? Wait. Yeah. Okay. All right. So this is the content of my presentation. Okay, I'm not very good at doing a lot of creative visuals and all that. So I hope you bear with me. My slides are pretty basic, but I try to make it as interesting as possible for you guys. I know it's just after lunch. Everybody is having a lot of oxygen going to their stomach instead of the brain, but try to keep awake. I'll try to make it as interesting and as brief, but compact for you guys. All right, so this would be the content of my presentation. First, I'm going to talk about the standards that is specific to the preparation of group accounts. I'm going to talk about the types of group accounts. I'm going to talk about the steps to preparing group accounts under acquisition method. You will see why there are several methods of preparing group accounts, why the methods are different from different types of relationship. And I'm going to talk about the exemptions and limitations to preparation of consolidated accounts. And I'm going to talk about preparing group accounts, but under a separate method, which is equity method. I'm going to touch base a little bit about joint arrangements and also what kind of additional disclosures that is very specific to group accounts. And I'm going to do one illustration to prepare group account, SOPI in specific, because SOPI is the more difficult of all four group accounts. SOPI, preparation of group SOPI is the most difficult. So I'm going to give you an illustration where I combine both acquisition and equity method. All right. So these are the standards specific to preparing group accounts. When we talk about standards specific, it means that the standards will not be in use if you are preparing a single entity account. In other words, if it's just a Sendirian Berhad, there is no subsidiary, there is no associates, you do not really have to look at these standards. So I am using the international standards. In Malaysia, we have our own name. Numbering will be slightly different for IAS, but since we have international students with us, so I'm just going to use the international standards numbers to refer to the standards. Okay, the first one is talking about IFRS 3, which is all about business combinations. So in this standard, they talk about what are the kind of business combinations that we have. Business combinations are basically where one company acquires control over another, and both companies are in the business of making profit. So if you have a non-profit oriented company which acquires control over another non-profit organization, then you really do not fall under IFRS 3. This is just solely for business purposes. Then we have an older standard, which is IAS 27. Now this one, initially this was the only standard pertaining to consolidated financial statements. But over time, they find that there are certain parts of this standard that has not been argued or outlined extensively. So this standard has to be read together with the next standard, which is IFRS 10. So in IFRS 10, it's all about determining control Because once a company is considered to have control over another company, then that company has to prepare a consolidated financial statement, which is outlined under IAS 27. So basically, IAS 27, what we use it for is to give us a guideline on how to prepare the consolidated financial statements, whereas for IFRS 10 is to determine whether one company has control over the other one. If one company has control over another company or few other companies, that company that has got the control would be required to prepare consolidated financial statements. Now, this is only true for companies that are public listed. Okay, if the companies are not public listed, they are under MPERS, which is the Malaysian Private Entity Reporting Standard. They are not required to do a consolidation because their accounts are not being viewed by the general public. They have lesser shareholders, and the shareholders basically are very intimate to the company, so they probably come into the meeting room and all that. But if it is a public listed company where they have multiple number of shareholders, and shareholders may be holding a few shares here and there, and they're not important enough to be called in for meetings and all that, then you will be required to prepare the consolidated financial statements. Okay, then we move on to IAS 28. Now, IAS 28 is all about investments in associates and joint ventures. Now, a major difference between a company over one company has control in, if a company, let's say company A has control in company B, then that company B is known as a subsidiary, anak syarikat. Ya. In bahasa Malaysia, we call it anak syarikat. But if one company only has significant influence, okay, then it would fall as associates, and later on we will see a little bit on joint arrangements, because one type of the joint arrangement also falls under the jurisdiction of IAS 28. So what is IAS 28 is all about? It's about the guideline on how to prepare group financial statements for associates as well as joint ventures. So what we can say is IAS 27 is for preparation of consolidated financial statements where control exists. IAS 28 is preparation of group financial statements where only significant influence exists. Okay, now I would like to share with you an analogy about control and significant influence. I give you an example, a very simple example. Let's say my daughter. When she was a little girl, I have full control over what she wears, okay? I'll tell her to wear that dress, she wear that dress. So that's full control. But as my daughter grows up, you know, I start to lose control bit by bit up to a certain point. Now that she's in her 20s, I can't control what she wears, okay? But I can give her an input of what she should or should not wear. Let's say she's wearing too short of a skirt. I don't like it. I tell her, no, your skirt is short. She might or might not listen to me. But I have a significant influence on her decisions, okay? But I cannot control her fully on what she wears. She sometimes, occasionally, she would defy me. She will not follow what I say. So that is significant influence. However, control means you get to dictate what the other company has to do. Okay, so I hope you guys are very clear about the difference between control and significant influence. Then I'm going to touch base a little bit about joint arrangements. There are two types of joint arrangements, one of which has to use the IAS 28, and that will be called as the equity method. They have to use equity method to prepare the group financial statement. Last but not least, a little bit on the disclosure, extra disclosure required for group accounts, because you have disclosure for normal single entity. Those disclosure are still applicable, but these are extra disclosure required of group accounts. I hope so far you guys are clear. So actually, there are three types of investment, And there are two types of group financial statement. Now, a normal investment would be where you hold less than 20% of its ordinary shares, or maybe less than 20% of influence inside its board of directors and so forth. So that one is known as the normal investment. That one falls under IFRS 9. That one, you do not have to do any group financial statement. It is sufficient for you to show your investment in accordance to IFRS 9. What we're going to look at are the preparation of group financial statements. Okay, there are two types. One is called the consolidated financial statement, where control exists. The control existence will be determined under IFRS 10. Okay, as this is otherwise known as business combination. And the standard the standard that is to be used as a guideline to prepare the consolidated financial statement is called IAS 27. This is the first method. We call it the acquisition method. This is when control exists. And the relationship is between a holding company and a subsidiary. Now, the second type of group financial statement is called the equity method. For equity method, only significant influence exists. And the guideline to prepare the group financial statement is under IAS 28. So they're really quite different, okay? Control exists, IAS 27. Control existence determined by IFRS 10. Okay, but if only significant influence, you have to refer to IAS 28 to prepare your group financial statement. All other types of investment will be governed by IFRS 9. Are you okay so far? Do you understand? Ke dah mengantuk semua ni? Okay, I've put in the summary a little elliptical, what would you call this? Oval, right? It's this oval, colored oval box. So basically, I've given you the criteria regarding the consolidated control IAS 27 acquisition method and the other type of group financial statements where only significant influence exists. It will be governed under IAS 28. It's called equity method. Now, what is control? When does control exist? Okay, there is a whole control model under IFRS 10 for you to look at to determine if control exists. But let's take a look. It is very simplified, very simplified. We are just going to look at the ownership of ordinary shares. So let's say E Limited owns 75% of the ordinary shares. Anything that is 50% and above, we deem as control exists. Okay, anything 50% and above, ownership of ordinary shares, we deem control exists. So likewise, when you look at IFRS 10, when you control, let's say, 50% or more of the members in the board of directors, then control also exists, meaning to say that control is not just limited to ownership of ordinary shares. Control can exist in other forms. So we'll come to IFRS 10 in a bit. Let's just take a look at one simple illustration here, where the parent owns 75% of the ordinary share. Another party, okay, since this A Limited has got control, we call it parent. We can call it holding company, no problem. But in my class, I like to use the word parent, so it's easy for me to distinguish between control and significant influence. So I like using the word parent and subsidiary. So if A Limited has control, it is considered to be the parent, and therefore Thermocafe is considered to be its subsidiary. Okay, whereas you have another party, X Private Limited, only owns the balance 25% of the ordinary shares. We call this party as non-controlling interest. A previous term used was minority interest, but they've changed the term to be more reflective of its situation, its relationship with Thermocafe, because it has interest, but it's a non-controlling interest. Non-controlling interest, we will call it NCI for short, NCI. So subsequent to this, I may refer to NCI. That means I am referring to the party that owns less than 50% of the control. Okay, so they are called the non-controlling interests. Okay, so far? Now, let us take a look at a situation where you can have only significant influence. Okay, so here I've outlined 3 companies, Aru, Banyan, and Chiku. Each one does not hold 50% or more of the ordinary shares. Aru holds 40%, Banyan 30%, and Chiku holds 30%, with a total of 100% for all. But none of these companies have any control over ABC Private Limited. Okay, so this situation, no control exists, and therefore ABC Private Limited will be known as associate to Aru Limited, associate to Banyan Limited, and also associate to Chiku Limited. So what is the percentage of associate? From 20% significant influence to less than 50%. Okay, when we talk about ordinary shares ownership. Okay, so it starts from 20% to less than 50%. Anything that is below 20%, that is under IFRS 9, that you do not have to do any group financial statement. Are you guys okay so far? Is it clear?
Okay.
Clear, not Miss Lily?
Yes.
Okay. Now, we're just going to go through very briefly each of the standard that is specific to the business combination. So the first one, we're going to talk about IFRS 3. Now, the name of this particular standard is called business combination. Okay, business combination. And this one, if I were to sum it up in one sentence, I would sum it up as this is a standard that basically gives you the guideline on how to value the initial cost of investment in your investee. So in this standard, they will tell you how to calculate what is the value of the initial cost of investment. Okay, so we are going to zoom in very specific to the acquisition method. So under IFRS 3, when we talk about the acquisition method, this standard gives you a guideline on how to calculate the goodwill. Okay. And also, what is very important to determine the acquisition date. So what is goodwill? Okay, let me give you an analogy. Let's say I have 10 sets of Marvel comics, let's say, okay? I have 10 sets of Marvel comic. And the fair value or the market value of my comics is it's a very rare collection, maybe dated back a few decades ago. So it's in very good condition. So for that 10 sets of that Marvel comic, the market value is, let's say, RM 20,000. Okay. Now, somebody wants to buy my Marvel comic collection because they are collectors, right? Obviously, they are collectors for a lot of things. So we're just talking about Marvel comics here. So someone approached me and said, I would like to buy your Marvel comics. And I said, oh, well, if you want to buy it from me, I know the market price or the fair value of my comics is 20,000 ringgit. You have to give me more as an incentive for me to part with my Marvel comics. And this person said, yeah, sure. Why don't I buy it from you at 23,000? So that is an extra 3,000 ringgit over the value, the fair value or the market value of my comics. That 3,000 is an incentive for me to part with my comics, and the other person really wants to take over my comics, is willing to pay 3,000 ringgit extra. That 3,000 is goodwill. You guys get it? So that means if you were to put this in a context of business, you can have a market value of the business. The market value of the business is actually the fair value of the net assets. The fair value of the net assets is assets minus liability equals to equity. I guess you guys are very familiar with the accounting equation where assets is equal liability plus equity, right? So if you take the liability, you bring it over to the asset side, you get net assets. Assets minus liability is equals to net assets equals to equity. Okay, why am I going through this? Because later I'm going to teach you how to calculate the goodwill. So you need to know this. Okay, So this one, the standard gives you a guideline on how to calculate the goodwill. The goodwill must be reported as part of the consolidated financial statements, replacing the investment value inside the subsidiary. I'll tell you why we need to replace the investment value in a bit, okay? But let's go through IFRS 3 first. Here, of course, under IFRS 10, you need to determine whether control exists. If control exists, you are known as the acquirer or the company that has got the control. Then under IFRS 3, it will give you a guideline on how to determine the acquisition date. Why do we need to do this? Because the goodwill absolutely must be calculated on the date of the acquisition. That's why this standard, like I say, if I were to sum it up, is to give you a guideline on how to value the real cost of investment when you are preparing the group accounts. Okay, so the acquisition date, if it's a simple matter of one lump sum acquisition of ordinary shares, let's say you acquire straight away 80% of the ordinary shares of another company, then obviously that would be the acquisition date. The problem arises is when you do a piecemeal acquisition. Maybe you start with 20%, then you add another 20%, then you add another 30%. So at which point is considered to be the acquisition date. So that's why this standard is required to be referred to when you need to prepare your consolidated accounts. Then the standard also tells you how to recognize and measure the assets, liabilities, and as well as the non-controlling. Everything has got to be valued at fair value. Fair value. Okay. It's not the book value. So at the point when you are calculating the goodwill, all the assets and the liabilities must be measured at fair value. Even the payment made must be measured at fair value. Okay. And at the end of the calculation, you will get either a positive goodwill or you get a bargain purchase, which is also known as the negative goodwill. Okay. Now, we are going to go a little bit on IAS 27. This basically gives you a guideline on how to prepare the consolidated financial statements, how to account for change in ownership interest, and how to prepare the separate financial statements and whatever related disclosures that is required. Okay. Now, what are separate financial statements? When you have a holding company or a parent, you have to present two sets of financial statement. One is a single entity just for the parent, showing how much they paid for each of the investment type that they have, okay, in accordance to their standards. Now, the second set that they have to prepare, if it's just parent and also subsidiary, they have got to prepare a second set of financial statements, which is known as the consolidated financial statements. So this standard tells you there must be two sets. One is consolidated financial statements and also must show the separate financial statements where it is just the figures from the parents' books, but the parents have to show their investment, how much they pay to get the investments in other companies. And of course, when you do the consolidated financial statements, where you combine all the balances of the parents and all of its subsidiary, you are showing it as a single economic entity. Now, this is a very important concept for you to understand because by viewing this group of companies as a single economic entity, only then you understand why we need to do several adjustments when we prepare the consolidated financial statements. We are presenting these few companies, the parent and all of its subsidiary, as one single entity. And this is called the acquisition method. Now, what is the rationale of presenting it as a single economic entity? Because the parent has got control over the other company. So in other words, the parent can make use of the resources of these companies to their whims and fancies. That is why the standard requires the parents do or prepare the consolidated financial statements. So this single economic entity is very important for you to remember. Okay, Now, under the IS 27, we have very limited criteria to determine whether control exists. So these are a bit limited and because the criteria was a bit limited, it was subject to a lot of manipulation. Okay, especially when a company set up a special entity company in special purpose entity or special purpose vehicle, they call it SPV or SPE, where they can park their liabilities in this SPE and they have off-balance sheet liabilities. They can do a lot of manipulation with regards to this. And also, prior to this, there was a little bit of contradiction between IS 27 and also SIC 12. SIC 12 is an interpretation of a special interpretation of the standard where SIC 12 talks about special purpose entity, and the way they discuss special purpose entity is quite different on how it is discussed under IAS 27. So there was a little bit of contradiction there, which is why later on IFRS 10 was introduced to put a rest to all this contradiction. Okay, now under IAS 27, really there is only 4 types of situation where control might exist. One is, of course, when you obtain the voting rights. Voting rights are only obtained through acquisition of ordinary shares, okay? And when the management gets, or the company gets to govern the financial and operating policies of the entity under a statute or an agreement, maybe they have a special agreement, they can actually dictate the decision making of the other company, so that one control is assumed to be present, or the company has got the right to appoint or remove the majority of the members of the board, or they get to cast the majority of votes at a meeting of the board of directors. Why is this? The first point is different with number 4, because number 4, you may not have majority of votes, but you can have a special relationship with the other shareholders that allows you to control the majority of votes. So this happens actually when I had some shares before, before the AGM, there are some parties will send me a form asking me to delegate my share votes to them. So when these parties do that, they are trying to gain control. They may not hold 50% or more of the ordinary shares, but during AGM, they want to cast their votes. There are certain decisions that they want to make. So they will approach the small shareholders and hopefully some of the shareholders will respond to them once they get this letter of undertaking. They will use our votes to add on to the current votes that they have. So this is point number 4. Okay, now, like I say, IFRS 10 was introduced after post-financial scandals as Enron, because one of Enron's wrongdoing was they had a special purpose entity which they created to park a huge amount of loan from the bank, but Enron owned less than 50% of the shares. The other shares were put up as collateral to another party, but the running of this special purpose entity was all done by Enron. So if you look back at the IS 27, out of these 4 criteria, none of it will catch this kind of business arrangement. So what happened then? Enron got away with not showing the liability on their financial statements. It's off balance sheet. They probably mention it as part of their notes to accounts, but I think a lot of stakeholders, very few actually go through the notes to the accounts. So most people would just look at the face of the financial statement. Okay, the standard was also issued out to address the conflicting guideline between IAS 27 and SIC 12. So what IFRS 10 has done, it has extended the definition of control beyond this that was covered under IAS 27. And they introduced a control model that is more of a substance than form, because anything can fall within the scope of the control model. Okay, so there are 3 elements in a control model. If all these 3 elements are fulfilled, that means control exists. They give you examples, but it's not close-ended, meaning to say that it's substance over form. Any situation that fulfill all these three elements, then control is deemed to exist in whatever form. It can be in a form of caveat, it can be in a form of agreements, contracts, or whatever. Okay, they give you examples, but it's not exhaustive, meaning to say there can be other situations, but as long as the three elements in a control model are fulfilled, then control is deemed to exist. Number one, if they are power over the investee. Please note, they will give you examples what kind of power that might exist, but they say that is not the end of the list. There could be some etc. at the bottom. Whatever, however way you gain power over the investee, as long as there is power over the investee, we deem that control exists. And this person that has got power over the investee must have exposure to variable returns from its involvement with the investee. Variable returns means they have a right to dip into the profits of the investee. Okay, they are not fixed to maybe just interest. They have a right to take the profits coming from the investee. And they must also have the ability to use its power. They may have the power, they may have the rights to the variable returns, but they are being stopped by another caveat, which stop them from exercising their power. Then in that case, they are not deemed to have control over the other investee. So all three elements must exist. Okay, so I'm just going to go through with you very quickly. There are some examples as outlined under the standards where control may exist. When you talk about rights, the rights can come from voting rights or potential voting rights, not even current rights. What is potential voting rights? When you have things like share warrants, when you have things like convertible debentures can be converted to ordinary shares. So upon conversion, which is maybe in a few months' time, you will get control over the other company. Okay, so even if you have potential voting rights, you can be deemed to be the parent as long as you have got the ability, you've got the rights to exercise the conversion to ordinary shares. Okay. And when we talk about rights, we are also talking about rights to appoint, reassign, or remove investee scheme management, rights to direct the investee on transactions that benefit the investor, other types of rights. You see, they don't give you specific rights. They say other types of rights, any other kind of rights that gives the holder the ability to direct the relevant activities. So if you notice, this is the drive of the new IFRS. Everything is substance over form. They do not press the definition of what is required under the standard. They tell you the spirit of the standard, and after that, it's up to the accountants to determine whether this fulfills the spirit of the standard or not. They give you examples, yes, but the examples are not conclusive, okay? Then, what about special relationship where control may exist? Maybe the other party gives funding, guarantees, services, and materials. For example, let's say the other party give you a guarantee towards a loan because they give you a guarantee for getting a loan from the bank. They get certain rights in the company that affects the decision-making of the company. So even if this other party do not hold more than 50% or more of the ordinary shares, this other party may be deemed to be the parent because it gets to dictate decision-making of the other company through the guarantee and also the agreement made pertaining to the guarantee. And whatever substantive rights, you must have the ability to exercise, and also you can have in a form of protective rights. Maybe you are the biggest creditor, and therefore you said, before you take another loan or before you engage another creditor, you have to get our green light. So maybe that could be determined as a form of control. You have to look at it case-to-case basis. They are just giving you certain examples, okay? The accountant will have to sit down and think and to determine to what extent do these people who have got these protective rights via covenants, okay? To what extent do they dictate the decision-making of its company? Okay, if it's enough to denote control, then that particular company must be known as a parent and therefore must prepare consolidated financial statement. Okay. And there are certain exemptions to preparing consolidated financial statements. We go through the theory part of things first before we look at examples. So the exemptions to preparing consolidated financial statements when the parent shares or debts are not publicly listed. That means in Malaysia, only public listed companies are mandatory to prepare the consolidated financial statements. If it is a Sindra and Berhad and you are governed under MPERS, you do not have to prepare consolidated financial statement because, as I say just now, your information is not made public. But if you're a public listed company, your information is given out to the public. Okay. Or when the parent is also wholly or partly owned subsidiary of another company. On top of the parent, there could be several layers of investment here. Let's say you've got A, private limited, whose parent is B limited, but B is also the subsidiary to another parent, which is called C limited. So C limited is the ultimate parent. Now, if the ultimate parent prepares the consolidated financial statement, therefore B, the subsequent parent, subject to the agreement to all of the shareholders, does not have to prepare the consolidated financial statements. Okay, and when the parent is about to file its financial statements with Security Commission for the purpose of issuing public market instrument, usually when we are about to issue out new shares or new debts, we kind of freeze our activities for a while. So if the parent is in this process, they are exemption to preparing consolidated financial statements, okay? And when the investee is considered as assets held for sale under IFRS 5, so for example, you have got a company, XYZ Limited, acquired another company, let's say ABC Private Limited, okay, and it has no intention of integrating its business together with ABC. It is merely acquiring ABC as an investment to be sold off later. So this falls under assets held for sale under IFRS 5. Okay, so they give you about 1 year to dispose of this investment. If within a year you fail to dispose this investment, then it can no longer be considered as assets held for sale. Then this company that you earlier bought to be sold with the intention to sell off later on must be consolidated after 1 year. So they give you within 1 year to consolidate your position with the other company. And if the parent is an investment entity, meaning to say you are a mutual fund company. So it's very normal for you to buy shares in multiple companies. So it so happen, maybe you bought shares and you happen to buy more than 50% of the ordinary shares of one of the companies. But your business, your nature of business is actually investing. So you are not required to do the consolidation with the company because the main purpose of your company setup is for investment purposes. Okay. And then the parent must present the consolidated financial statements except the following. Okay, I think number 1, I have explained it to you. Number 2, when the debt or equity instrument is not traded in a public market and the company is not in the process of listing its instrument to the public, and ultimate or actually this is more of an explanation of the previous slide, but I just want to go to the second point where IAS 19 employee benefits apply. Okay, my old company was a US-owned oil and gas company. So for a brief time after I joined, they have another subsidiary to manage the pension funds for the employee. Okay, so the sole purpose of the other company is just to manage the pension funds of the employees, and therefore it is not profit oriented. The purpose of the company is just to manage the pension fund. Therefore, when it falls under IAS 19, employee benefits, you are not required to consolidate this company with the parent company because it's not profit-oriented. All right. And of course, when there is loss of control, the parent sold off the ordinary shares, or maybe they lost control through a specific agreement caveat, then the parent no longer have to prepare the consolidated financial statement. Okay, so far okay? All right. So I'm just going to go through the very brief basics on how to prepare the consolidated SOP. So when you do a consolidated SOP, the first thing you must do is calculate the goodwill. This is a requirement under IFRS 3. Why do we need to calculate the goodwill? Because we need to eliminate the investment value in the subsidiary. Why do we need to eliminate the investment value in a subsidiary? Because we are presenting the parent and all of its subsidiaries as a single economic entity. When you the other subsidiaries as single economic entity, and you still show your investment in all these different subsidiaries, it would not be right because you are really showing investment in yourself, isn't it? Do you see the point? Do you see it? Do you understand the point here? Nobody understands the point. Let's say you have got company A, which is the parent. You've got company B and C, which are both subsidiaries. You are going to add up together all the assets and the liabilities amount. You're going to add it up together, all right? And you're going to present it as one single economic entity. Now, if you still show the parent would have investment value in B and C, they will have to write it because when shares in company B and C, they have to debit the investment in in B and C, and they have to credit out whatever payments that they made. It could be cash, it could be debentures, it could be ordinary shares. Okay, so they will capture it as a asset, investment asset. But when you combine the balances of the parent together with all of its subsidiaries, and you still leave the investment in there, it's like showing you have investment in yourself. So that does not make sense. So therefore, we need to eliminate the investment. And in its place, we have to replace it with goodwill. So I hope you get the concept here. No worries. I will give you a very short illustration in a bit. Okay. And first thing you need to do is calculate the goodwill. Then find the balances of the company or the parent company with all of its subsidiaries. And we need to eliminate all intercompany balances and also unrealized profits. Okay, why are we doing this? Let's say the parent is A Limited. They sell inventory to B Private Limited, which is the subsidiary. So the parent gets a profit of 10,000 ringgit. And the parent will be selling the inventory at a certain invoice value, let's say 100,000 ringgit. And the B Private Limited, the subsidiary, will be buying it also at 100,000 ringgit. But there is an element of profit there of 10,000 ringgit. So basically, the parent is taking profit from the subsidiary whose balance will be combined with the parent. So it's like the parent is taking profit from the single economic entity. So therefore, whatever intercompany balances or profits you have to eliminate. You cannot show. It is a profit to one party, but additional cost to the other party. So both must be eliminated. Because, like I say, the concept of single economic entity is very, very important here when you prepare the consolidated financial statements. I hope you guys can see a bit. Don't worry, I will give you a short illustration after this. You will see how we do the adjustment. And also, we need to allocate the equity of the subsidiary to both the group and also the non-controlling interests. Okay, what are the non-controlling interests? Let's go back to this one. Okay, let's say Thermal Cafe has got an equity of 500,000. Equity is what? Equity is net assets. Equity is the the owner's portion of the wealth in the other company. But you have to bear in mind, the parent only owns 75%. So out of 500,000, the parent will only take 375,000, whereas another 125,000 will belong to the non-controlling interest, which is why when we prepare the consolidated financial statements, we have to allocate out the equity belonging to the subsidiary between the group and the non-controlling interest. Okay, now let's just go through very quickly for consolidated Sochi. For consolidated Sochi, of course, you have to eliminate whatever intercompany sales, eliminate whatever profits that comes from the sale of inventory. Why are we highlighting these first two items? Because in your P&L, the two major components inside your P&L is sales and also cost of sales. Okay, so there's a lot of, if there is a sale of inventory between the companies in the same group, you obviously have to eliminate quite a fair bit of balances there that is related to the intercompany transactions. Okay, now I'm going to show you guys how to calculate goodwill, because the first step in preparing consolidated financial statements is calculating goodwill. So now let me just give you an example here. ACE Limited has acquired 75% of the ordinary shares of B Private Limited on the 1st of October 2023. So the 1st of October 2023 is now known as the acquisition date under IFRS 3, because this is the first time where the parent gains control over the subsidiary. So the acquisition date is known as the 1st of October 2023, and therefore whatever balances you use in the calculation of your goodwill must be measured on the 1st of October 2023. Okay. Now, there is an immediate cash payment. I'm making it easy. In my class, it's not so easy. We have future payments, we have multiple payments, we have debts and all that, which needs to be discounted and so forth. But because we're just doing an overview, I'll give you a very simple example. So the immediate cash payment given for this purchase is 2 million ringgit. And the fair value of net assets belonging to B on the date of acquisition, 1st October 2023, was estimated at 2.2 million. So what is net assets? Assets minus liability equals equity. In my class, I would use the balances of the equity to get the value of net assets. And the net assets must be measured at fair value, not the book value. So adjustments to your assets as well as your liabilities, you have to factor that into your calculation. Okay, then the goodwill will be calculated as follows. First item is a consideration transfer, which is a cash payment. This one should be, sorry, wait. I think I made a typo here. It's 2 million. Oh, sorry, just hang on. I need to change that. This is 5. So this one should be 5. 5, sorry. Okay. All right. So the consideration transferred is 5 million. Okay, let's skip the non-controlling interest bit for a while. The fair value of the net assets belonging to the subsidiary is at 6. I think I changed some things, but I forgot to change the slides. Hang on here. It should be 6.25. Yeah. All right. The fair value of the net assets belonging to the subsidiary is 6.25 million. Now, what we are comparing is the consideration transferred to buy 75% of the ordinary shares. So obviously, you cannot compare this payment for 75% of the ordinary shares against the 100% fair value of the net assets belonging to the subsidiary. So we need to top it up with the non-controlling interest value. There are two methods to calculate the non-controlling interest value. I will just show you one method, which is based on the FV&A. So you should take 25% from 6.25 million. Then you will get 1.562.5 million. And if you take the payment made, 5 million, plus the non-controlling interest minus the fair value, you will get the goodwill on the acquisition date to be at 312,500 ringgit. Okay? Boleh? So this is a very basic formula for calculating goodwill. Of course, in my class where we have 14 weeks to learn all these things, the consideration transfer is usually not given direct like this. You have to do a fair bit of calculation before you can get the consideration transferred. And also when you need to calculate the net assets, we put in a lot of adjustments there as well, such as the fair value adjustments for assets as well as liabilities. Okay, now let me just show you very simple calculation of on how to prepare the consolidated statement of financial position. So this is given as at 1st October 2023. So you only have two sets of financial statement, SOPI. I'm just doing SOPI here. You got A as the parent and you got B as a subsidiary. So this is the investment in B, 5 million. These are all the list of assets and liabilities and also the equities belonging to both parent and subsidiary. So in the previous slide, we have calculated the goodwill to be at 312.5 thousand. Please take note, when we prepare the consolidated SOPI, I have taken out the investment. Okay, you need to take out the investment, you need to credit out the investment, and you need to replace it with goodwill. So in your consolidated SOPI, the initial cost of investment in a subsidiary is no longer there. It is replaced by goodwill. Okay, so the double entry is actually debit all your FB&A, debit, let's say in your FB&A, we've got ordinary shares, we've got retained earnings. We've got two here, right? So your double entry will then be debit 5 million ordinary shares, debit retained earnings 1250, debit the goodwill 312.5, and credit out the investment, which is 5 million. Okay. Then if you notice for land, I have combined the balances for A's and B. So I get 13 million here. For PPE, I'm doing the same. I combine it together. So I get 9.7 million here. So this is, do you see why we call it presented as a single economic entity? Do you see why we say this? Because we combine the balances of the assets as well as their liabilities. Excuse me. I do the same for inventory. I do the same for receivables, for bank. Everything is combined together. So I get combined asset value. Okay. Why does it doesn't I think I made a mistake here. Wait, where did I check this? Wait, I will give you I think I did the correction, but I probably took the wrong Excel spreadsheet because it doesn't balance. It should balance. I'll give you the correction in a bit. Okay, so just now we have used okay, whatever that we use in the calculation of this is 6250, right? Look at the FB&A net assets. I should have broken it up so you can see it better. How I get 6250 is this. 5 million plus 1.25. Okay. That's how I get 6250. I've used it in the calculation of goodwill. So therefore, I'm going to eliminate it when I do the consolidated SOPI because I've used it in the calculation of goodwill. Okay. So therefore, for ordinary shares, it would just come from the parent company. For retained earnings, it comes from the parent company as well. The non-controlling interest is coming from this one, the calculation of goodwill. Okay. And the payables would be a total of 3.6 million plus 1.1 million. Can I do a correction here? I can't. Let me just total it up. Give me a moment. Okay, never mind. I will come back to you on the figures. I think there is a type. The ordinary share should be 23,000. This one? It is not 20, it should be 23,000. If I change this 23,000, you will get 35,662. It should balance. Okay. All right. Boleh tak? Can ah? There is a typo here. This one, 23,000, it should be reflected as 23,000 here, not 20,000. Boleh? Everybody understand? Nobody understand. Everybody has gone to sleep, is it? Faham ke? Lily, you faham tak? Tak, the ordinary shares, there's a typo. Dekat my current slides, so there's a typo. Ordinary share should be 23,000. That's why I'm short of 3,000 dekat I punya balance. When I combine the figures, it should be 23,000 dekat ordinary share, not 20,000. You faham kan? Okay. Kalau you faham, orang faham lah. Tapi tak ada orang jawab, so I was a bit worried. Okay. All right. So there are some limitations of consolidated financial statements. The data is obviously aggregated. When the data is put together, some information will be lost, especially when the business combined, they are from different types of industry. Let's say the parent company is manufacturing of machines, for instance, whereas they have a few subsidiaries which are retailing in clothes, for instance, right? Maybe they have a diverse business. So if you combine the balances together, it's very difficult to see the synergy of the group because the group is combined from different industry. Okay. And also, from a legal perspective, the parent and all of its subsidiaries are legally separated entities. So let's say the parent is making a lot of money, is making a lot of profits, has a lot of assets, very little liabilities, and they combine it together. After combining it together with a few of the subsidiaries, and one of the subsidiary is not doing so well, making a lot of losses, that loss is actually embedded. It will reduce the group profit in total, but you will see the group as making profits in total, whereas there are certain members in the groups, they are not doing so well in the business. And also they are separate legal entities. So it's not reflective of the strength of the companies in the group. Okay, so there are limitations to consolidated financial statements. Okay. Now we go a little bit on the second method, which is called the equity method. This equity method is applicable when significant influence exists. And this one is governed under IAS 28, which is investment in associates and joint ventures. Okay. And what is outlined in this particular standard, it gives a guidance on application of equity method. The investment would be initially recognized at cost. That would be the purchase price. And after that, you have to add to it all the post acquisition equity. You have to take your portion from the associate post acquisition equity, and you have to add it on to the initial cost of investment. Okay. And that will give you the updated investment value in your associate. You know, sometimes we talk about it in sentences, we don't really see what's going on. So I'm going to show you guys how we prepare group SOPI using equity method. So over here, Harry Limited has acquired 30% of the ordinary shares issued by Taylor Private Limited on the 1st of January 20x2. So the investment or the initial cost of investment in associate, that is the purchase price to get this 30% of the ordinary shares in Taylor, 1.3 million. And we have given you a brief SOP for both Harry, the holding company, and Taylor, the associate. Okay. Now, how do we prepare the group statement of financial position? Please take note. First, what we need to do is update the initial cost of investment, 1.3 million. You need to add to this the post-acquisition equity. If you look at the post-acquisition equity, we only have retained earnings here. So this financial statement is dated on the 31st of December 20x2. Acquisition is on the 1st of January 20x2. So your post-acquisition RE would be profit for the year, which is 600,000. And Harry owns 30%. So Harry would take 30% times 600,000. Harry will only take its portion from the post-acquisition RE. Okay. Here, the calculation is showed here. So the updated value in the associate is 1.48 million. So we're going to put that inside the group SOPI, 1.48 million. And if you look at the non-current assets and current assets, the numbers are only coming from Harry only. Okay? Please take note, I do not combine the balances of Taylor together with Harry. So we are not presenting this group as a single economic entity. Harry is only showing its rights to the value inside the associate company. So it's very different actually from the acquisition method. Now, if you go back to the acquisition method just now, if you notice what I did in the working, I combine all the balances of the subsidiary together with the holding company. But we are not doing that for the equity company. For the equity company, we only update what is the value of investment in the associate. We put it here. The rest of the balances comes from the holding company only. Okay. However, for group retained earnings, I'm going to total up the opening balance of RE for Harry, profit for the year, plus the contribution from the associate RE. Okay, I'm going to add this up and I'm going to get 5.48 million. And the current liabilities, again, will just come from the holding company, which is Harry. So you see, these two methods are really quite different. You guys are okay? Boleh faham? Who is in the... Yeah, who? Where can I see who's inside the name? Maybe I should call names. Any one of my students in this briefing, do you understand? I guess everybody's mic probably rosa or something. Okay, we're going to go through very briefly two more standards that is specific to the preparation of group financial statements. One is joint arrangements. Now, why is joint arrangements being mentioned here? Because there are two types of joint arrangements. One is called joint operations. The other one is called joint venture. Now, out of these two types of joint arrangements, only joint venture will apply equity method. Whereas the other type of joint arrangements, which is joint operation, will use proportionate consolidation method. Okay. And last but not least, these are some examples, some extra examples of disclosures, extra disclosures required in the preparation of group accounts. Okay. You have to outline what are your significant judgments and assumptions when you are preparing your the group financial statement, and you have to show your interest in the subsidiaries, the group composition, who are the significant NCIs. You don't have to show everyone, but you certainly have to highlight the significance or the material ones. You have to show, you have to give a list as part of your notes to the accounts. Who are your significant or your material subsidiaries? Who are the significant NCIs related to the subsidiaries? And then if there are any kind of nature and extent of restrictions between the companies in the group, and if there are any risks in the consolidated structured entities, in the form of maybe financial support to a member of the group, acting as guarantors and whatnot. And maybe if there are changes in ownership interests that do not result in a loss of control, let's say you used to hold 80%, you sold off some of your shares. So last year you held 80%, this year you only hold 75%. You have to show changes in ownership. And if you ever lose control of a subsidiary, what are the consequences pertaining to gain and loss? So these are some of the examples. If you go through the standards, they have got a long list of things that you must disclose in your consolidated financial statements. Okay, that ends the theory part of it. Are you guys interested to look at the calculation? I have actually prepared an illustration. Are you guys interested to go through, or you guys are not interested? Not interested? Then no need to go through lah. No, nobody is saying anything. Okay, I think my time is almost up. But if you guys are interested, I can attach the sample question, and maybe you can ask the organizer to share the sample questions with you guys if you're interested to look at a brief example where I have incorporated both acquisition and equity method. So you can see how we prepare both methods, and we come up with one group statement of financial statements. Okay, in this question, we have got one subsidiary, which is Mini Sdn Berhad, and we've got one associate, which is called Nano Sdn Berhad. Okay, so if you guys are interested, I've put in all the, what do you call it? I put in all the workings on the side by side. You guys can go through and see how I do the final product. I prepared the final product, which is a group statement of financial statement. Okay, I guess, yeah, that's it, Miss Lily. My time is up, I guess. All right. Any question from the audience? Any question from the audience?
Thank you, Madam Mas.
Dana? Okay.
Wait, maybe one question, boleh?
Boleh? Who wants to
Ah,
ask question?
Apa, it's interesting, you give the analogy about controlling controlling your daughter. So, just wondering,
Yeah.
is IAS 28 talking about control, significant
IS
influence?
28 is talking about significant influence.
Yeah.
Mm.
So, does this significant influence ni based on share ownership and
It is just it's following the line of IFRS 10, meaning to say for IFRS 10, they outline what are the control model, right? So that is 50% and more. You can apply the same situation for significant influence, but not as a control, but just as a significant influence, meaning to say that you can have a caveat, you can have agreement, you can have restrictions, not control, but significant influence, then you are considered to be a holding company of an associate.
so it's to share. The other one talking about to having a directorship. Is that count
Yes,
also?
yes. Let's say you have got 10 members of directors. If you control maybe 6, then you are said to have control over. If a 6 comes from your company, then you are said to have control over the company, even if you do not hold the shares. But the first guide that we look at is, of course, the ownership of the ordinary shares, the voting rights. But let's say you have a situation where there is no clear parent in the picture. Everybody probably holds 20%, 25%, 15%. There is no clear parent in the picture. Then we go to the control model to see if there are any agreements, if there are any, contracts or caveats or whatever that can maybe assign an investor who has 40% ordinary shares ownership, they can assign that person to have control over the other company. So this is when your IFRS 10 comes into the picture.
Okay, so just a little bit more because does it say anywhere there? I want to refer to 1MDB. Does the standard, which standard talk anything about shadow director, or how do you interpret like the Jolo control of the 1MDB board?
Oh, do you have the structure of 1MDB directorship? Do you have
No,
it with you now?
no. I don't have structure at all. It's just that I'm just wondering if there is any financial reporting standard talking about shadow director without
Oh, I
being,
see.
yeah.
Shadow director.
Mm.
It can fall under IFRS 10. It can. Because the IFRS 10 give you a model which is not conclusive. Meaning to say, if someone comes into the picture, argue, yes, they've got a hidden power behind certain parties, they got a hidden agreement, yeah, it will fall under IFRS 10.
Okay. Alright. Okay, thank you.
Welcome.
Okay.
Any other question?
Yeah. So there is any more? No more question. Everyone happy? Uh,
So how do
so
I unshare this? Okay, I stop here.
stop
Stop
sharing.
sharing. All
Stop
right.
sharing. Yeah. Okay.
Okay.
Uh, so all right then. Okay lah. Thank you very much, Madam Maslina, for your presentation today.
Welcome.
So we are uh we are in the evening already. Here is 3:25. I believe over there in Bandung it's 4:25 perhaps. We have one final speaker. Our final speaker is a senior lecturer. Her name is Madam Nik Khadijah. So Madam Nik Khadijah, before a little bit about her. Before teaching, she was working in financial services sector, specifically in the area of construction, properties, and hospitality. More than 19 years. So she brings with her knowledge and practices from the industry. She joined us in UniKL Business School in 2012. Um, her, her teaching interest is management accounting. In fact, I also co-teaching with her many times before she did this subject in our business school. So I think with that short introduction, I would like to call upon Madam Nick to proceed with your presentation today. If you can start sharing. Madam Nick, are you here? Ready?
Okay. Got. Speak louder.
Yeah, I can hear you.
Okay, just share.
Yeah. Going to share the slide and video perhaps. It's up to you. Okay, we can see the slide now. Good.
Okay. Dekat dengar suara tak tadi?
Yeah, Assalamualaikum. Can you hear me?
Salam. Yeah, we can hear you.
Okay, can I start now?
Yeah, proceed. Yeah.
Okay. Assalamualaikum and a very good evening to everyone. Welcome to my presentation on corporate failure. Okay, today I'm going to share with you the definition and types of corporate failure, the effects of corporate failure, the factors of corporate failure, how to minimize corporate failure, or what are the remedial measures. Okay, okay, let me share with you. Okay, a quote by Harvey Mackay, a successful American businessman and best-selling author. He says that failures don't plan to fail, they fail to plan, okay? And then from a quote by Winston Churchill, the former Prime Minister of United Kingdom who led Britain to victory in the Second World War, his quote, "He who fails to plan is planning to fail." Okay, I'm going to share with you also today some companies which had already collapsed and or bankrupt. Okay, such as Theranos, 1MDB, Enron, Indopharma, Silicon Valley Bank, MyAlign, and Tupperware. Okay, what is the definition of corporate failure? It is actually inability of a corporate organization to conform itself with its strategic path of growth and development to attain its economic and financial objectives and legal obligation. Okay, there are three types of corporate failure. One is a corporate body with low or negative returns. The second one is a corporate body that is technically insolvent. Technically insolvent here means also known as technical insolvency. That is, a company can have the value of its liabilities rise at a faster rate than that of its assets due to increased debts or borrowings. The third one is a corporate body that is bankrupt. Okay, what are the effects of corporate failure? The possible effects of corporate failure include one is increase in the level of unemployment. Two is decreasing standard of living. Three is underutilization of resources. Number four is increase in crime level. Number five is instability of the banking system due to inability to pay back borrowed funds, loan repayments. Okay, instability of the financial markets where short to medium and long-term funds were sourced, and corporate failure makes it impossible to meet such obligations. Okay, there are causes of, actually corporate failure could be caused by number of factors such as managerial inefficiency and ineffectiveness. Number two is social cultural factors. Number three is economic instability, and number four is public policy. Okay, managerial inefficiency and ineffectiveness actually is the most pronounced source of corporate failure due to lack of a well-articulated plan, such as overexpansion. Overexpansion is where a company that undertakes overexpansion is likely to immobilize short-term funds, thereby creating an avenue for corporate failure. Okay, another one is ineffective sales force. Ineffective sales force. If the sales force is not properly trained and developed, the company may find it difficult to sell its product, especially if the product is sold in a highly differentiated competitive market, such as luxury goods. Normally, the customers or the potential customers is not going to buy both the luxury car BMW, and also Mercedes, okay? The potential customer will buy only one. So for this type of product, it is in a highly differentiated competitive market. The consequences is the cash flow problem and solvency problems. Okay, another factor under this managerial inefficiency and ineffectiveness is high production costs. This high production costs, this could be due to overemployment of human and material resources or technical inefficiency in the production process. Another one is poor financial management. A firm whose financial manager is unable to take effective financial management decisions, such as investment, financing, and dividend policy, is bound to experience liquidity problem. Another one is risk assessment strategy. Investments in assets constitute the most important source of corporate earnings. Thus, if risk assessment is not properly done, corporate income will be impaired. Again, under this managerial inefficiency and ineffectiveness, we have capital inadequacy. A firm that is undercapitalized is bound to fail sooner or later. The reason is that the firm will not have enough capital to buy the relevant fixed assets, invest in enough income-generating assets, or enough working capital. Very often than not, such firms experience underutilization of capacity. Another one is absence of manpower training. A firm that does not have manpower training as well as development policy cannot make use of well-trained and specialized staff that can help in the achievement of corporate objectives and goals. Inappropriate commercial policy is the policies affecting sales, especially credit sales, should be carefully evaluated since such could lead to debt buildup and by implication liquidity crisis. The second one is socio-cultural factors. A firm that produces products which are not absorbed by the immediate environment will have tough times selling its products. It will force the firm to look for distant markets, which will lead to higher marketing costs and inability to sell its products. Number 3 is the income instability, which is the environmental, economic, or income instability refers to the consumers and customers end, can lead to corporate failure. The reason being that any downturn in the economy can create some form of financial distress due to a firm's inability to sell its products. Okay, number 4 is the public policy. Public policy is a very important external source of corporate failure. When government policy is against the interests of a firm, even within the short-term period, the firm could go bankrupt. For example, if government places a ban on importation of a firm's input, production will be impossible when the existing stock inputs are exhausted. This is example in from Australia. Okay. The whole legal retail vape industry has been forced to close in Australia with bankruptcies, unemployment, loss of stock, etc. While the black market, that is the criminal networks and outlaw biker gangs, will thrive with further firebombing of vape and tobacco shops, contract killings, and extortion. So this will cause a huge enforcement cost. So the authorities have seized nearly 500,000 illegal vapes with a street value of 15 million, according to 9 News Australia. Okay, this one, this happened in, wait, let me check. I think in January of this year, if I'm not mistaken. Okay. Okay, how to minimize this corporate failure or remedial measures? The most effective measure of averting corporate failure is the institution of a very effective management. It is the responsibility of management to look at all areas of operations to see how efficiency could be induced. Such areas include staff training and development. This is important in the sense that the employees are expected to lead all areas of job performance, and the essence of training is to make them improve on job performance. Number 2 is enhancement of productivity and business process re-engineering. Okay, business process re-engineering. Okay, BPR, business engineering, is actually the radical redesign of business processes to achieve dramatic improvements in all areas such as productivity, cycle times, quality, and employee and customer satisfaction. Okay, this consists of 3 important areas, namely improvement in productivity. Okay, I've already mentioned just now the productivity. What else I've not mentioned is application of appropriate financial structure, increasing the level of competitive advantage in the marketplace. Number 3 is the effective management of the product and product market. Okay, this is recent example, failure due to diminishing trends and social media marketing and marketing and hype, especially among Gen Z users, influencers, etc. Okay, Tupperware files for bankruptcy as its colorful containers lose relevance. Lose relevance. So now a current trend or preference over Tupperware is the Stanley's viral cups, which are Stanley's viral cups are such a status symbol that kids are getting mocked at school for having off-brand dupes. 1 month's viral TikTok says. Okay, the Stanley Cup craze is how a 110-year-old company went mega viral. This Stanley is a product from US. Okay, strong Stanley's customer experience is the story from Ohio woman says her Stanley Cup saved her from a bullet. The story you are about to hear is unusual, but it is certainly true. A woman managed to survive a stray bullet from hitting her, all thanks to her Stanley. And there's another scenario. It's a true story where, let me see, I think it's in the video I can share with you. Okay, I think this is the Tupperware. Let me share with you about the Tupperware bankrupt first. Yep, yeah. Aku selalu buka kat sini kan. Nak buka apa? YouTube. Cikgu punya video. Cikgu punya video untuk Tupperware. Ni kan? Sekejap. Ni dia di sana. Apa? Ya. Kan. Dah banyak. This one, is it?
This one. Upload. Nak start dari semula.
Let's start with semula dah kat cikgu di situ.
Video stop dah stop lah.
Okay, dah tak ada. Tutup boleh.
Sound, tak ada sound. We cannot hear any sound. You need to share with sound. Wanik, tak ada sound.
Dia kata apa?
Tak ada sound.
Tak ada sound, no sound.
Ni lah. Kan ke?
Kan.
Ni ke?
Kan.
Sound.
Tak tahu macam mana nak buat sound kat sini daripada ni. Daripada
You need to unshare and share again with sound. I think there's a check button for sound.
so it means kena stop sharing tu lah.
Yeah. Stop sharing and click share tu.
Okay,
I think there should be a checkbox. Share including sound or something.
Sekejap. Share. Now dengar tak?
No,
Ha?
tak ada. No sound.
Ada. Tak payahlah tengok gambar je lah.
Tengok gambar je lah.
Kita tak biasa pakai Zoom. Yang this presentation you can find out also in the YouTube.
Cari audio setting.
Klik. Bukan klik situ.
Okay, tak ada.
Okay. Share back. Share. Tutup. Tutup. Okay.
Yalah.
Ya. Okay.
Okay. Dengar tak suara dia?
Click this one. Okay. Full screen. Bawah.
Slideshow.
Yeah. Security alert. Okay. Okay.
Okay, boleh tengok ke? Can you see the slide?
Yes.
Okay. So, this is about what? This is about, this is tadi kat sini ya. Sorry ya. This is the another companies which had already collapsed and bankrupt also. This is my airline. This is 1MDB, Indofarma. Okay. Yes, I have done. Failure due to poor governance, mismanagement, management's fraud triangle, ineffective business policies or strategies, and bad financial and investment decisions. These are the causes. Okay. Failure due to poor governance, mismanagement, and management's fraud triangle. What is this management's fraud triangle? Is according to Albrecht. The fraud triangle states that individuals are motivated to commit fraud when three elements come together. One is some kind of perceived pressure. Another one is some perceived opportunity, and the last one is some way to rationalize the fraud as not being consistent with one's values. Okay, let me share with you. Okay, what happened to this? This is about my align. My align.
Meet Matterport, the market-leading 3D platform that lets anyone turn a
Ah,
physical.
ada sound.
My
Ada sound
Airline
dah?
was an
Okay.
airline made to revolutionize the Malaysian aviation industry. Operating primarily from the Kuala Lumpur International Airport, they offered passengers low ticket prices in an effort to boost demand and carve out a niche for themselves, just like Ryanair, but in Southeast Asia.
Okay.
However, this fairy tale was short-lived, as My Airline failed in just 1 year. So what happened? At 5:30 a.m. in the early morning of October 12, 2023, My Airline suddenly suspended operations just 10 months after they commenced and cited the reason to be financial issues, which were pending shareholder restructuring and capitalization. There wasn't any prior warning, no signs pointing to a possible collapse, and no excuse of a pandemic or conflict. They just decided operations weren't economically feasible one day, packed up, and announced it when most people were still asleep. The announcement came as an obvious shock to passengers of My Airline, who had flights booked for later times, with 40 booked for that very day. In fact, around 125,000 passengers with tickets worth over $4 million were affected by this abrupt announcement, and some of them had even arrived at the Kuala Lumpur International Airport that day without having an idea of what had just transpired. The collapse of an airline barely 1 year operational came as a shock to anyone in the aviation industry, especially if we look at the promising signs it showed at the beginning. You see, My Airline came into a market that was seemingly improving, and with the way demand was rising, especially in Southeast Asia, they probably took the bet on running a low-cost carrier without too much consideration. Initially, things were looking very promising. Due to its rapid expansion, My Airline was also able to hit its 100,000th passenger just over a month after its first scheduled flight, and passed the 1 million mark within 6 months. They were even looking forward to an initial public offering sometime in the near future, as they looked to expand their investor base through the stock market. It's no surprise, though. I mean, they were in one of the fastest growing regions for air travel after all. Plus, key factors such as a surplus in terms of airport slots and skilled aviation-related professionals were available to them at a relatively low cost. You see, at the start of its scheduled operations, My Airline had a fleet of only 3 Airbus A320s and operated initially to cities like Langkawi, Kinabalu, Kota, and Kuching. But as of October 2023, they had an all-Airbus A320 fleet of 10 aircraft, 6 of which were leased, with the type being suited to low-cost travel as well as offering fleet commonality. Now, during the earlier days, My Airline's flights had an average load factor of 75% across its network, with some flights even capturing a 100% capacity. They continued to rapidly expand operations by adding some new local destinations such as to Tawau and Miri, as well as adding cargo services. Plans to serve international destinations across Southeast Asia, such as Thailand and Vietnam, were also on the drawing board, with flights to Bangkok actually commencing in late June this year. It was important for My Airline to capture some market from these countries, as Malaysia is within a 4-hour radius of them. This sort of range is a gold mine for low-cost carriers, as they are able to complete multiple flights within a day. This looked like insane growth from the outside, but what it turned out to be was just proof that you should never judge a book by its cover. Because by mid-October, My Airlines announced that it suspended all of its operations. In reaction to the announcement, the co-founder of My Airline, Dato Alan Goh Huan Hua, who controls a 98% stake in the airline, was arrested together with his wife and son as they were investigated for money laundering, amongst other things. It turned out that he had been abusing investor funds after he had 15 investors file lawsuits against him for obvious reasons. And it gets even worse, because up until today, the airline's employees have been complaining about unpaid series stretching back over 2 months, with many of them applying for aid from social security organizations. The airline has also been accused of late payment of dues to service providers as well as having difficulties in raising funds for new aircraft leases. Former CEO Rainer Teo had to step down due to health issues just before the collapse and was replaced by interim CEO. Now, if you think that this was the end for My Airlines, then you might be in for a surprise. Because despite looking like their old board had scammed investors and tried to exit, My Airline is still trying to make a comeback. They are currently in talks with potential investors and submitting several proposals. They intend to restart operations and pay their employees, as well as refund affected passengers. But they have already faced some difficulty in raising any funds in the past, even though they had controlled around 10% of Malaysia's domestic aviation market. Now, with such an occurrence, it has become obvious that the Malaysian aviation authorities need to review entry requirements and policies for new airlines. It is quite telling that the authorities, including the Civil Aviation Authority of Malaysia, were caught unaware of My Airline's financial struggles when they should be regularly updated, especially about financial situations. It is also telling that Mavcom awarded a license to My Airline in the first place, because this essentially meant that they were okay with the level of capital available to the airline and satisfied with their business strategy. To many industry observers, it was hard to agree that My Airline met such requirements with its unrealistic business plans, and they look to have been proven right. My Airline's business plan was basically to fill the potential void that could have been left by AirAsia following its predicament during the pandemic. On paper, this might have sounded like a great plan, as AirAsia did hold over half the share of Malaysia's domestic market. They felt that if they could undercut AirAsia, they would be able to get some of its customers. This worked to an extent. However, AirAsia is still something of a behemoth in the region, and if there's one thing to go by in a capitalist market, it's that the biggest companies always have the advantage when it comes to competition. You see, all AirAsia simply had to do was to lower costs to levels that weren't economically feasible to My Airline. Sure, they did make losses, but they were able to maintain their customer base, and they offered routes that My Airline didn't, so they were able to use those profits to mitigate the losses. My Airline tried to keep up, but by the 6th month of operation, they had already run out of investor money and were bleeding cash. In a last-ditch effort, they tried to pivot to international travel so they wouldn't have to directly compete with AirAsia. However, pivoting to international routes requires significant investment, and both money and time were against them. Even getting themselves slots at international airports proved to be a hassle. Besides, even if My Airline had secured the capital they so badly needed, the competition in Malaysia is still too high. AirAsia, Malaysia Airlines and Batik Air are all more established and have developed their customer base over years, so it's a tough ask for any new airline to overtake them without cutting corners. There could still be some light for My Airline at the end of the tunnel. As the market for regional flights in Southeast Asia continues to grow, there will be entrepreneurs who could show a keen interest in a carrier that has proven in the past to be able to take up considerable market share from the big players. However, they would have to clean up their act, especially in financial terms, and find a system that would ensure long-term sustainability and profitability, rather than just stealing market share and running at a loss. Regulators across Southeast Asia should also ensure that new airlines follow sustainability guidelines and have financial reports filed regularly so they don't fall into a similar situation. So what do you think about My Airline's fall from grace? Could their business model have been sustained by securing more investments, or was it always doomed to fail from the start? Please share your thoughts in the comments below.
Waiting for around the world cruise.
Okay. Well, I forgot to share with you that actually there's one story about the Stanley Cup. The one that I've already shared with you is regarding it's about the cup save a woman from a bullet, but this one is about the Stanley Cup also, where satu kereta itu terbakar ya, and then the owner of the car found out that the Stanley Cup tidak terbakar and the ice is still there. The ice was still there, and then it became viral. So the Stanley company gave the woman a new car, replace a new car. Okay, itu buat Stanley lah, yang boleh dah ganti dengan Tupperware, dah ganti Tupperware. Iklan. Actually, it's a it's something like a free advertisement to Stanley, right? Okay, let me share apa lagi nak share. Okay. There's another company, Indonesian company that is Indofarma. This Indofarma, the Supreme Audit Agency in Indonesia has uncovered several issues and fraudulent activities within the ailing state-owned pharmaceutical company Indofarma and its subsidiary, Indofarma Global Medica. One of the notable findings includes the use of employees' names to secure online loans amounting to rupiah 1.6 billion equals to 77,000 US dollar. Okay, itulah sedikit sebanyak about the Indofarma. Okay, this is about the 1MDB.
It was supposed to be a vehicle to attract foreign investment. Instead, 1MDB has sparked embezzlement
dengar ke?
and
Can
money
you hear the
laundering
sound?
investigations across
Yes,
the
can hear.
and a search for an enormous pile of missing money. Started in 2009 by the then government under Najib Razak, the fund's early initiatives included buying privately owned power plants and planning a new financial district in Kuala Lumpur. But 1MDB proved better at borrowing than attracting investment, ultimately finding itself $12 billion in debt. Investigators have been trying to find out how money flowed through and around the fund and illegally into personal accounts. The US Justice Department says more than $4.5 billion moved through a complex web of transactions and fraudulent shell companies. The Swiss say up to $7 billion passed through 1MDB and one of its units. The hunt has seen Najib charged with corruption, criminal breach of trust, and money laundering involving 1MDB-related funds. He denies any wrongdoing. Goldman Sachs is also facing criminal charges, with prosecutors seeking fines of more than $3 billion. Malaysia alleges the bank misrepresented how the proceeds of bond sales to 1MDB, totaling $6.5 billion, would be used, knowing the funds would be misappropriated. Goldman denies that and says it will vigorously defend itself. Finally, fugitive Malaysian financier Jolo is in hiding, accused of leading a small group which diverted money into personal accounts designed to look like legitimate businesses. Some of that cash is thought to have been used as kickbacks to officials, including Najib and his allies. Low has been charged in absentia with money laundering as authorities look to dispose of his assets, including a luxury yacht.
Okay, stop. Okay, that's about the 1MDB. Okay, this is another company, Enron. This is about Enron. A notable example of failure due to poor governance, mismanagement, ineffective business policies or strategies, unethical accounting practices, and fraud. Enron scandal in 2001. It is a Houston-based commodities, energy, and service corporation. What happened? Shareholders lost $74 billion. Thousands of employees and investors lost their retirement accounts, and many employees lost their jobs. The main players is the CEO Jeff Skilling and the former CEO Ken Lay. How they did it? Kept huge debits off the balance sheet. How they got caught? Turned in by internal whistleblower Sharon Watkins. High stock prices feel suspicious. Okay. Fun fact, Fortune magazine named Enron America's most innovative company for 6 years in a row prior to the scandal. Okay, let me see whether or not there is a, yes, there is a video also. Okay. Langsung bahas dulu ya. Oh, ini dia. Dia buat MDP. Okay. Tak ada pula dia. Cikgu ke kena type sini. Cikgu search aku. Search aku.
Tak ada ya. This one, is it? Pilih one of this one. Untuk kita Google showroom. Okay.
Enron used to be the 7th largest corporation in the United States. At one point, valued at over $70 billion. As of 1997, however, they started losing money and accumulating debt. Instead of admitting their mistakes and making changes, Enron executives decided to hide the losses through accounting errors because they didn't want the Enron stock price to go down. Risky decisions kept being made, and the truth was hidden under the rug. As of 2001, however, the media started wondering whether or not Enron was overvalued. This obviously put a lot of pressure on Enron stock prices, which used to be as high as $90.75 per share. Insiders decided to cash out and started selling lots of shares, and prices kept falling until they ended up at below $1 in late 2001. In December 2001, Enron ultimately filed for bankruptcy. Approximately 20,000 jobs and $2 billion in employee retirement funds were lost. Many executives were brought to justice, and some of them ultimately ended up receiving prison sentences. Enron was an early example of just how recklessly some corporations are managed. We then had countless other examples, mainly in the financial industry, especially after the Great Recession of 2007 to 2008. Do you see a pattern?
Okay. Okay, let me share with you. This is about the Theranos. Failure due to overly ambitious and being a total sham or bogus. This one, this lady, the Elizabeth. Okay, this is the blood test, a machine to do the blood test. She claimed that 1 drop of blood can diagnose many types of but actually it is a normal machine, blood test machine. So many people or many companies have already invested in her company. So sudden, okay, this one ada kat sini. They drop out, I think. Drop out, still drop out standard.
Biotech company Theranos promised a blood revolution.
Mama, dia tiga bapak dia. Bapak dia.
Medical tests.
Yang besar.
Except the technology didn't exist. At least not in the way that its founder, Elizabeth Holmes, envisioned it. But that dream is over yet. Theranos made some pretty lofty promises that would have upended traditional blood testing as we knew it, with its mini lab dubbed the Edison.
If you could have just a single drop of blood, you wouldn't need to go to a lab and get your blood drawn for testing. It would make it so much easier, really revolutionize the blood testing industry. Like, that's an appealing promise.
Nicole Wetzman is a health reporter at the Booth. She's spent time covering the Theranos trial from the courthouse in San Jose and explained to us why the blood testing industry even needed a company like Theranos to begin with.
For a standard blood test, you have to go and you go sit down, and a lab tech will draw vials of blood out of your arm, and then it gets sent out to a lab, or some larger offices might have machines in-house. So Theranos claimed to be able to create a system that would kind of circumvent a lot of those challenges. So they said that they could have a tabletop doctor's office sized machine that could run hundreds of blood tests on a single drop of blood.
But even from the beginning, pathologists questioned the accuracy.
What I'm surprised about is, you look at the people in the room, and there's clearly been a lot of interest in your company. I would argue that a lot of that comes from the fact that there were these claims that were made that were very broad early on. 70 tests, the whole, panoply of lab tests from a couple drops of blood. And the evidence that you presented fell far short of that.
There are things that you can do with a single drop of blood. You can test your blood sugar level, for example. But there are other things where a single drop is just not realistic. There might not be a high enough concentration of what you're trying to measure in a tiny drop.
Studies have shown that important blood markers, such as white blood cell count or hemoglobin, can vary greatly from one drop to another when obtained via the finger. But even if individual drops were identical, certain tests need to separate out cells with a centrifuge or add specific chemicals to the samples that would make repeat testing impossible. Theranos' ambitions are commendable, but the idea was nothing new.
So there are things that Theranos was going to do that are also things that more realistic researchers are also working on. You kind of have a couple of main things happening. You have the single drop of blood issue, you have the lots of tests on one sample issue, and you have the let's shrink this all down to a small machine. And those all kind of individually are things that people are working on. But those are really hard, and there are a lot of kind of really significant challenges that a lot of smart people are working on. Experts do not really think that that sort of pie in the sky vision is something that's really going to be feasible, despite kind of the potential for a lot of this stuff to really be improved and innovated on in reality.
While many researchers have been trying to advance this technology in labs, a ton of buzz surrounded Theranos because it was telling investors it could all be done right now. According to testimony from the trial, Holmes was telling investors that the machines were already being used on military helicopters in combat zones. These claims would not only come back to haunt Elizabeth Holmes in her fraud trial, but they also had a chilling effect on other research being conducted in the field of blood testing.
Folks who are working on blood testing technology and trying to shrink down tests or do more with less had trouble getting funding or interest because investors said, well, Theranos has already done this, so why should we invest with you? And then when it came out that Theranos couldn't actually do what they said they were going to do, you had sort of the opposite problem where people would say, oh, but isn't that all just a scam? And so that made it harder for people to attract funding for their more realistic projects.
As we approach the end of the trial,
Okay. I think this is going to be the last one, the Silicon Valley Bank. Silicon Valley Bank. This is the failure is due to the poor investment decisions and lack of diversity in banking business operations. Okay. Why did it collapse? The collapse happened for multiple reasons, including a lack of diversification and a classic bank run, where many customers withdrew their deposits simultaneously due to fears of the bank's solvency. Many of CVB's depositors were startup companies. They deposited large amounts of cash from investors because tech was in high demand during the pandemic, said Jay Zhang, founder and managing partner of Embark Advisors. So I have the video also for this one, CVB, to share with you.
No matter how cheap we don't want to buy, as long as the stock is still coming down. Okay, we don't want to tap the falling knife. And this is
A rough week for the banking industry. The collapse of Silicon Valley Bank, the second biggest bank collapse in U.S. history.
the Silicon Valley Bank collapsed on March 10 after a run on deposits due to tech-focused lenders' plans to raise fresh capital. This prompted US regulators to step in with emergency measures, including seizing another bank 3 days later in a bid to ease fears that depositors might pull their money from other lenders. WSJ banking reporter Rachel Ensign explained how this crisis unfolded and what could happen next.
during the pandemic,
But not
Silicon
the
Valley Bank
origin
had got
punya,
all
apa ni,
these
original
their
owner lah.
deposits triple. It was a huge influx.
Okay,
And
so that
they
yang
did what banks do. They took some of the deposits and made loans, but they also invested a lot of them in securities, which are pretty safe. Some issues had been bubbling under the surface at Silicon Valley Bank. Reserve started raising rates. When rates rose, the bonds fell in value. It's not a big problem for you unless you have to go and sell the bonds. But deposits started leaving the bank faster than they anticipated. And they had to sell their bonds and take a very big loss. The bank made an announcement on Wednesday night that it needed to raise capital and was planning to do that the next day. The investors completely freaked out, sold off the stock, and then a bank run started where people tried to withdraw $42 billion in deposits just in that one day. And by Friday morning, it was seized by regulators. The regulators have responded in a way that they're hoping stems the panic. The Fed said, we're going to be offering this lending facility that's a backstop. We're going to be insuring all of the deposits effectively of this bank that failed.
Lepas tu lah. Lepas tu baru.
The collapse matters because it could have broader economic effects. There was the risk that this panic would spread to other parts of the banking system. We saw some really significant news with some of the banks that investors were most concerned about last week. Most notable, Signature Bank, a New York-based bank, was also seized on Sunday night. It is the third largest bank failure in US history. And First Republic put out a statement saying they've gotten some extra money from the Federal Reserve and also from JP Morgan. They're hoping that that reassures their investors and their depositors. The key thing to watch for is the panic over? That's the big question. Do people stop pulling their money out? Do investors and consumers are they reassured that the government is likely to be?
There are no one drop of blood can test everything. Yeah. Dia kata Alif Shukri, one medicine can solve all medical problems.
4 decades after its creation, Silicon Valley Bank was the 16th largest bank in.
Okay. Okay, failing to plan is planning to fail. This is a quote from Ellen Lekin. Okay, thank you. Terima kasih. That's all from me. Titiang lungsur mapamit dumun. Saya rasa orang Indonesia semua faham, ya. Yeah? It's terima kasih. Saya pergi dulu. Bye-bye. Okay, thank you. Assalamualaikum.
Salam. Yeah. Thank you. Thank you very much.
Yes.
Thank you very much,
Sama-sama.
Madam Nick. Yeah, we can open for question just quickly when you was presenting just now on Theranos Elizabeth Home, interesting case study. So
Yeah.
it kind of remind me, I share a link, I will show it here. It's about, we have a similar thing in Malaysia. There's a local
The
influencer.
Alif Shukri? Yes.
Yeah,
Please share with us.
yeah, I already shared the link in the chat.
Yeah.
So the link is Channel News Asia did a documentary on Malaysian health supplement. So the story goes about influencer. So about this influencer, they people nowadays don't go to experts anymore. When they are sick, they don't go to doctors, but they go to influencer. So this is one example. People, yeah, in some cases, people die because this is about your health, right? So if you go and watch you click the link that I gave, I use this in my class lah. How they if Theranos one blood can test apa 70 types of tests, but this influencer Alif Shukri, one bottle of medicine can solve many type of health issues. Of course, I have to say that his product already, a few of his product already been banned out from by our local health ministry. He got fined for it also. It's
Cikgu
interesting.
boleh deliver volume.
Take a look lah. Take a look at the video. Yeah, go ahead. So, ada apa-apa ke? Anyone have question?
If I could just add to that.
Yeah, go ahead.
The thing is, some time back, I was just Googling about medical symptoms and whatnot. If you Google in English, it will take you to this medical pages website written by medical doctors. If you Google in Bahasa Malaysia, they will show you all sorts of potions that give you promises of instant relief from everything. You try that, you see that. I think it's just a culture of our people. We always look for alternatives rather than going to a proper doctor.
Yeah, I think desperate people being a little insecure is vulnerable, and we need to remember there are a lots of opportunities out there that will take advantage on people, especially when there's a monetary gain involved. Halal or haram doesn't matter for them. So I believe for me that is the lesson learned today, going through from Madam Nick talking just now. In the morning, Dr. Inu also talking about the fraudulent financial statement using IFRS 16 with her Banish model, and also Madam Maslina earlier talking about manipulating about the control with many different case study, including Enron, and in Malaysia, one of the biggest one, there will be one MTB having a so-called shadow director. Without shadow director means the name of this person, Joe Low, is never in any official document when it comes to the one MDB as in the company of one MDB. However, he's pulling the string and controlling. Yeah. So I don't have anything else. Kalau ada apa-apa lagi, anyone else? Just want to remind also to everyone before logging out today, we are towards the end about the attendance. You have to click the form for day 3. There's a form in the chat.
Azam.
Yeah.
Okay. Take 4. Actually, I would like to wrap up. Cikgu tolong itu sebab dia echo. Boleh? Dengar tak?
Yeah.
Okay. Can you hear me? Okay.
Yes.
I would like to wrap up for this 3 days lecture series. We would like thank you to all the lectures at Universitas Muhammadiyah Bandung and lectures at UniKL Business School, Foundation in Business and Accounting Department. Okay. I would like to say a little bit about the last presentation by Madam Nick. Actually, is a good thing. You as accounting student do not only conform within the textbook. You have to read. Because in every cases you will learn something. Okay, if it's also a trigger a question in your head, and you will observe what kind of manipulation and strategy did by an expert in particular area. For example, the latest, the last one, the banks in United States, Silicon Valley Bank. It must trigger you as an auditor. How come the last year financial position auditor did not comment on the cash flow of the company, the liquidity of the company, what was going on? Yeah, that's why we trust auditor to give like true and fair view and give opinion. The company have some liquidation problem, the company ratio, but then how you combine your knowledge with off balance sheet activities, that you see is also go back to Dr. Inu presentation. We talk about fraud. Yeah, this all involve the one major ecosystem go back to human values and ethics. Yeah, until a certain extent, everybody have access and power to certain amount of money. You become a chief financial officer, you become CFO, you become prime minister, you become minister of finance. Yeah, you see all these decision made by human being lead to that scandal. Okay, why this going on? Because they are lie, they are cheat, they are loose of their ethics. So along the way, okay, I don't want to see any student from UniKL Business School or UST Muhammadiyah end up like some of the like Enron case. Those are the student from Harvard inside behind the bar. Okay, so it goes back to the value as a Muslim. Yeah, you have to conform to your religions. Don't steal the money. Don't manipulate the account. Be a good husband and wife. Also, that one is another one, additional. Okay, be a good person. Don't, because like whatever you earn now, is if you filthy rich, you filthy rich, you don't carry all the inside your grave, right? Okay, so we have a balanced life whatsoever lah, so it goes back that the human decision, okay, human decision impact the world as entirely. So I want you back and think and relook everything that you learn within these 3 days. Yeah, how this thing affect and your financial decision and your make decision in the future. Okay, because nowadays your generation like to show off in the social media this kind of lifestyle whatsoever until you willing to commit certain crime. For example, just initiate just cheating, copy paste for exam, copy your friend this one everything. So there's a slightly indication towards that when you become a power, you feel like it's okay to steal somebody asset whatsoever. Okay. So thank you again to Mr. Azam and the MC for the 3 days. Okay, I hope we'll benefit both party and we will continue this insightful program in the future. Thank you. Go back to you. Any from UMB? Or any student want to give your opinion? Student UniKL, ada apa-apa nak bagi pendapat ke? Azam, can you hear me?
Yes, I can hear you.
Okay, so if there's no opinion or any other feedback, maybe we can close this officially.
Yeah, so then thank you very much to all the speakers today, Madam Nick, Madam Mastina, Dr. Inu. So I hope you have benefited the last 3 day session. Hopefully we can do it better in the future. Thank you very much. That's all for me. Then we can exit. Assalamualaikum. Bye bye.